The market said this was a bearish week for crypto, but that's wrong. Crypto didn't fall because the economy was weak. It fell because the economy is strong. I mean, we added 130,000 jobs. Expectations were 55,000. And rate cuts just got pushed further out. So while traders were selling because now they think we have fewer cuts coming, BlackRock just put US Treasuries on Uniswap. And that contradiction is the signal. If you allocate capital in 2026, this week mattered because it revealed three structural signals: what the Fed is likely to do next, where institutional liquidity is quietly moving, and why the Clarity Act and the stalemate we're experiencing in Washington may accelerate DeFi instead of slowing it down. So guys, in minute 3, I'm going to break down what institutions actually care about right now. And it's not Bitcoin's price. But first, let's start with the data. 130,000 non-farm payrolls added. Consensus, 55,000. Unemployment, down to 4.3%. That, my friends, is controlled strength. Not overheating, not a recession, but rate expectations shifted. After this came out, the rate expectations shifted immediately. March rate cut probability fell to 6%. April dropped to 23%. And crypto dipped because liquidity timing changed, not because the fundamentals deteriorated. And that distinction matters. Bitcoin briefly slipped below 66K. Open interest is now down more than 50% from the October highs, and retail participation is starting to become muted. But that's not panic. That is just deleveraging. And when positioning gets crowded and macros shifts, leverage is first to unwind, right? We've seen it before. So what matters though? What matters is what replaces it. Because stable rates don't equal anti-crypto. They equal selective capital allocation. And that is where the real story begins. Because while traders were de-risking, institutions were building. Because the next part is what institutions care about the most. And BlackRock, we saw BlackRock listed its 2.2 billion tokenized Treasury fund. BUIDL, that's BUIDL in case you want to go look it up. They listed that Treasury fund on Uniswap. Treasuries, on-chain, tradable via DeFi rails. Compliance handled by Securitize. Access limited to pre-qualified participants. This isn't a marketing headline. It's infrastructure expansion. And the key isn't just the fund. That's the signal. So stay with this, right? Stay with this because the Clarity Act fight directly ties into this move. So guys, what is the strategic positioning of BlackRock? What do they see? Because rates are elevated. Stablecoin yield is politically contested. Banks are drawing a hard line against allowing stablecoin rewards. Why? Why are they doing this? Because yield-bearing stablecoins compete directly with deposits, right? It's how they make their money, and they're being threatened. Because if consumers can earn yield on chain, banks lose their deposit float. So what does BlackRock do about it? They tokenize treasuries instead. They bring real-world yield on chain through compliant rails, not through savings accounts, not through traditional deposits, through decentralized settlement infrastructure. And this reframes the policy battle entirely. Because if stablecoin yield gets blocked, tokenized treasuries can fill the gap. Capital doesn't disappear, it simply reroutes. And that brings us to the Clarity Act. Because crypto and banking lobbyist groups had just met again at the White House to no compromise. Nothing was reached. We probably knew that was going to happen. Banks, though, expanded their list of restrictions around stablecoin rewards. And the Clarity Act, which has already stalled once, is now stalled again, and the path forward still remains uncertain. But here's the structural consequence. Regulatory friction doesn't stop innovation. It simply redirects it. If banks prevent yield-bearing stablecoins, capital will shift into tokenized securities. If deposits can't compete, DeFi settlement becomes the alternative, and that increases the importance of infrastructure chains, which brings us to Ethereum. Because Bitmine Immersion acquired 40,613 Ethereum during the pullback. Total holdings now sit near 2.9 million Ethereum, roughly 2/3 staked. Generates more than 200 million annually in staking income alone. They now control over 3% of total Ethereum supply. Yeah, they're sitting on paper losses. They are. And the stock, Bitmine stock, it has declined this year. But they're not trading price momentum. They're accumulating network exposure. How come? Because tokenized treasuries, staking yield, and real-world assets all settle on chain. Ethereum isn't just a speculative asset in this framework. It's financial infrastructure. And that's the institutional thesis. So now let's zoom out. Let's look at the divergence here and zoom out, 30,000 foot view, take a look at it all. Jobs, stronger than expected. Rate cuts, pushed out. Crypto dips, short term. But at the same time, guys, BlackRock expanding tokenized treasury access through Uniswap. Banks resisting stablecoin yield. Ethereum treasury companies accumulate supply. Short-term liquidity compression. Long-term infrastructure expansion. Retail watches price volatility. Institutions build the rails. That divergence is the opportunity because markets reprice liquidity quickly and infrastructure builds slowly. Once the rails exist, guys, capital flows through them regardless of the short-term sentiment. So guys, this was not a bearish week. It was a week of clarity. The labor market is stable. The Fed is cautious. Liquidity won't be handed out aggressively, but tokenization is accelerating. And if stablecoins can't offer yield, tokenized treasuries will foot the bill. If banks resist deposit migration, DeFi will adapt. If Ethereum becomes the settlement layer for tokenized finance, supply dynamics shift structurally. The market dipped, but infrastructure advanced. Those are not the same signal. And in the next video, we're going to go deeper into the tokenized treasury thesis and why it may become the dominant DeFi narrative of 2026. Because the real story isn't Bitcoin at 66,000. It's what's being built underneath it while retail panics. This is Luke with Ledger Prime. We'll see you in the next one.